I think we'll start. Good evening, everybody. On behalf of Volunteer Nova Scotia and the King's Volunteer Resource Centre, welcome to the first workshop of 2026. My name is Heather Killen, and I am the Program Coordinator for King's Volunteer Resource Centre. Just a few notes before we start our workshop. Tonight's presentation will be recorded. Now, if you don't want to appear on camera, that's perfectly fine. Just turn off your camera. But please keep your microphones muted. If you have any questions or comments, please feel free to put them in the chat and we'll try to keep an eye on it. There will be a time after the presentation for questions and answers. So, just keep that in mind. The session will go probably till about 8:30. We'll be taking a short 5-minute break, probably around 8 o'clock. Once the presentation is concluded, we'll end the recording and that's when we'll have the question and answer. So I guess without further ado, I'd like to begin by acknowledging that we're in Mi'kma'ki, which is the unceded ancestral territory of the Mi'kmaq people. We also acknowledge the contribution of people of African heritage in Nova Scotia for more than 400 years. We pay tribute to and are grateful to our ancestors who came before us. Make sure our history is not forgotten. And now I would like to introduce tonight's presenter, Richard Bridge. Richard Bridge is a lawyer based in Nova Scotia's South Shore. His primary area of practice for over 25 years has been charity and nonprofit law. His clients are a wide range of charitable organizations, foundations, nonprofit organizations, and philanthropists across Canada. He's worked internationally and taught university and college courses on charity law. In recent years, Richard's work has been focused on helping Indigenous communities build new relationships with the philanthropic sector. Richard, the floor is yours.
Well, thank you very much, Heather. Very, very kind of you and of Carla to invite me to join you tonight. And hello, everyone. Can everybody hear me okay? I can bellow, I can go quiet or whatever you prefer, or you can just adjust your volume and tune me out as you wish. So the topic tonight, let's get right to it. Risk management for nonprofits and charitable organizations. There's a slide deck that everyone will get a copy of, and it's 27 slides that attempt to distill this topic that can be kind of dry, kind of technical at times, into sort of a practical approach for every organization. So the slides basically do 5 things. One is a bit of a reference to risk and risk management definition in a basic way there. The second theme is an attempt to categorize risk in a practical way, just to help folks dissect their own circumstance and organize it for tackling. The third of the 5 themes is mention and a little bit of a deeper dive into 3 basic risk management strategies for your organization. The fourth of the 5 themes is how to create a risk management plan. And finally, there's some commentary on some supportive measures, insurance, and independent advice as ways to help control risk. So this isn't rocket science. It's not stuff that will blow the doors off for you. It's really just an attempt to help you with the process of breaking down your circumstances and identifying room for improvement, because this is the kind of thing that's into the category of continuous improvement with every organization. You're always facing changing circumstances and new opportunities, new challenges. And I find that these slides can be a little bit of help around dealing with those changing circumstances and keeping risk identification and management just part of your regular routine. So I hope that's what it does. Let's dig in. The suggestion from Heather is to wait until the end for questions. That's fine. You're also very welcome to follow up with me if you have a specific thing you'd like to chat about. Happy to consider that all part of this conversation. If you'd like to go offline separately via email or give me a call sometime and kick something specific around, happy to do that. So let's begin with the slide deck, if you like. So the first slide of substance deals with 2 bits of reference materials. Now, I have to confess, these slides are actually a bit old, but the principles are unchanged. They're sort of timeless bits of wisdom from others, really consolidated in one place. And it's two links to sources that are generally pretty good. For those of you in the charitable world, you may have come across Terry Carter and the work that his firm does in Toronto. They've been at this space longer than I have. I think Terry outnumbers me in terms of years in charity law by a few, and his firm has produced a lot of good stuff over the years. And this is just recognition of good work he's done on this topic. Mark Bloomberg is another lawyer in Toronto whose firm does a lot of work here, and I know they have risk-related materials available as well. So, two sources to consider if you want more backup. And the first one is from England and Wales. The Charities Commission there does very good work, and they're often the source of excellent guidance material. So, these particular slides do draw from some of their very interesting insights and conclusions based on sort of a bigger field of charitable organizations, but with very similar principles and themes at play around risk. It's kind of a universal thing. So I've just got something blocking my view. I just need to see if I can get rid of it. Good, it's gone. Excellent. Great. Okay, so what is risk? A little bit of definition stuff that's, again, pretty straightforward. There are lots of definitions of it. This is a particularly good one from the Charities Commission. So the uncertainty surrounding events and their outcomes that may have a significant impact, either enhancing or inhibiting any area of a charity's operations. So it's important to recognize the double-sided nature of risk. If you are completely risk averse, you do nothing and you miss out on all of the good stuff that you really come together to tackle and to make progress on. So risk it can be viewed that way. If you view it just as something inhibiting, then you're likely to hide under your bed and not go out and do your good work. So don't do that. This is not intended to scare anybody in any way. It's intended to really encourage you to keep on doing your great works, because without you, our communities would be pretty barren places. So that's a theme I always like to share, is that risk management should be a focus on the good stuff. How do you get your good stuff done? How do you do more of it? How do you avoid those stumbling blocks that can slow you down? So don't view it as scary stuff. View it as just ways to navigate. It seems to me as a sort of a sensible but positive casting for this stuff. There's enough complications in life. You don't need more, and fear of risk is not something that should be part of your daily work. What is risk management then? Practical question. It's very unique to each charity. So each organization has a very unique profile of risk and opportunity and the environment that it works in, and it's always shifting. I think we have perhaps the rate of change is faster now than ever. It's been a constant theme in terms of dynamic space charities occupy, but we're facing some unique changes. And on the opportunity side, you're all in a space that has just undergone and is now living quite significant change. And I'll just touch on it now. I could go deeper if you like, but it is the legislative and regulatory changes around the relationships between charities and nonprofits. Some of you may have done a deep dive on that already. Some may just be encountering it for the first time, but it's a space where legislative change has reworked, in effect, the risk profile for everybody in the charitable and nonprofit sector that engage in a sharing of resources between those two. So in real quick summary, it's now possible for charitable entities to make grants to non-charities, and that wasn't an option previously. So there's a change in the landscape, and you could view that from a risk perspective and say, well, might we get into trouble if we do that? Well, let's be really cautious. Or you can view it from the positive side and say, wow, what a wonderful opportunity. How do we do that really well? And that's where a lot of charities are really immersed right now. So happy, I suspect there might be some questions around that, and I hope there is, because it's a nice example of how the landscape shifting can affect the way you do your work, and you can quite fairly analyze that as part of your risk strategizing. So there we are. So it is unique to each charity, but there are some common themes, and that's one of them: changing landscape from a legislative perspective. Risk management is also good governance. Some organizations suffer from governance that perhaps isn't the best and are more exposed to difficulties. They miss opportunities. They may stumble into trouble more often. So good governance, I'll say a few things about that throughout. That's a separate topic if you wanted another hour conversation around some suggestions and best practice language. We'll get into a bit of it today, but that's a pretty important theme, obviously. It's competent administration. So governance is really a question of the relationship between members, board, and staff. Administration really focuses on the staff function, if organizations have that luxury of having a staff, but that's really an important piece of it. Care and attention to the charity circumstances by the board and staff. That's really the place where this kind of good work happens. It's also planning. It's care and attention to your strategic planning, your operational planning as well, and it's identifying again opportunities and potential challenges. And at the end of the day, it comes down to good judgment. Turn your minds to situations and come up with your best judgment on a particular set of facts, and that's really the best you can do. So it's sort of the benchmark test is did you apply good judgment? So moving along, here's an attempt to segregate risk into categories just to help break it down and digest it a bit. Failure to comply with the law, an obvious risk. Lots of examples of that. I don't think we need to give too many specifics. Again, the thing I've mentioned around the law of grant making might be one we can go into in a lot more detail tonight if you'd like. Governance risks, if your board isn't functioning properly, if your relationship between board and members isn't working, those are all risks to an organization. Operational risks, things can go wrong in the delivery of services and programs, and I know everyone has many examples of things averted and great successes accomplished as operational. Financial risks, the constant inevitable pressure of operating in this sector and frankly operating in any sector. Businesses face the same basic financial challenges and opportunities. And then external risks, they sort of overlap with the first four, but there's some specific examples coming up we can speak to. So it's kind of helpful in my mind anyway to try to break risk down into different categories, and you may come up with a different casting of the categories of risk in your world, but these ones aren't a bad attempt at that. So some examples of failure to comply with the law. For those of you who are with charities, you know the very ominous annual experience of completing your filings to the Charities Directorate. So the T3010 is the annual filing that has to be submitted on time, and on time is within 6 months of your fiscal year end. And if you don't do that, you'll lose your charitable status. So it's a really draconian approach to a pretty fundamental piece of reporting. So the reporting part is important for transparency and accountability to the public. But the punishment is pretty heavy-handed. It means you're automatically struck off the list of charities and you have to reapply. And that can be pretty challenging, and it's a very unpleasant experience. So it's a classic example I like to share with all charities because not all volunteers with charities appreciate the seriousness of that. And some organizations tumble into it thinking, oh, well, we're just a little late, no problem. But that deadline is absolutely firm. And I'll just give you a little illustration of it. Just recently, contacted by a charity that was late in doing their filing and lost their charitable status. And their reason for being late was that their audited financial statements weren't available yet. And had they called me before the deadline, I would have said, well, just give them the best information you've got based on your own internal papers. You don't need the audited statements in order to complete that. Because if it's wrong, post-audit, you can resubmit corrected numbers. Would have saved them tons of difficulty. Now, they've had to reapply. They're in the process of doing that. It takes months of hard work to reapply, and then it takes 6 to 12 months of waiting. So an example of a failure to comply with the law that's quite avoidable in terms of recognizing the way around that problem. Acting in breach of trust is another example of breach of the law that sometimes arises in the charitable sector. A trust, for example, around a gift. If someone makes a donation and says, here is a gift to do A, B, and C, and the charity does D, E, and F with it, well, there's a potential legal challenge there for breach of trust. So watch out for that sort of circumstance if you are receiving donations. Always Be very clear in your conversations with donors if you can. Now, sometimes gifts come via a will, and the potential to negotiate the terms of it are lost, or perhaps you had conversation in advance. But the basic message around breach of trust as a risk theme is there's an opportunity up front in many cases to be very clear with donors and to try to convince them of the merit of gifts that are largely unencumbered and gifts that are left to the discretion of the board of the charity, as opposed to something really narrow and specific. Now, sometimes that's just not possible. The gift is the donor is determined to make it for something specific. But in your conversations around receiving gifts, keep that in mind. And then you can avoid the negative side of risk, the potential that you go offside something that's narrow and constraining. And then you miss the opportunity of perhaps opening up a gift to be broad enough to maximize its positive impact for you. So it's a really interesting theme to ponder when you're engaged in any of that conversation with potential donors or funders. And I hope that's frequently for everybody. But there is room to sort of seize the opportunity under this complying with the law theme of risk management. The third one there is not meeting requirements as an employer, and this is a big one for a lot of charities. There's sort of a threshold that charities and nonprofits cross when they go from being purely volunteer to being in a position of the luxury of being able to have employees. Once you cross that threshold, I always recommend that organizations reach out to HR specialists, people who know employment rules and laws and mechanics really well, and strike up a rapport. Have somebody on retainer, perhaps, or invite somebody into the board who brings that bag of skills to your board to help you with that, because most litigation, and it isn't a scientific thing, but my observations are that most litigation involving charities and nonprofits involves employment problems, things that have gone wrong and end up in a tussle of some kind. And good practice, good process, good documentation of all of that stuff can really help you avoid difficulties, and then, conversely, pursue the opportunities that inevitably flow from the good position of having a staff to do your good works. So, bunch of potential problems can arise: civil actions, liability for the deductions that need to be made, CPP and income tax and EI, and those sorts of things. Setting that up early on with somebody well versed in this and making sure the finance team understands these things. Most finance people view this as bread and butter, and it's really not a big issue, but something to keep in mind for new entities crossing that threshold into the world of employment. Next slide, some more legal stuff. Improper use of charitable receipts is a big one. If you are a registered charity, you probably have it well drilled into the organization, the importance of managing your receipts properly. There are very specific rules from CRA on that, and there are templates and a lot of really good materials that you can draw from if you're in that circumstance. But do that stuff carefully and comply with the very particular guidance. Once you set it up, it's generally pretty smooth. Some of the thornier issues in this space include the valuation of gifts. So dollars, if somebody gives you cash, that's great. That's easy to measure. Somebody gives you a work of art or maybe real estate. Those things get more complicated, and there are very particular rules around appraisals and the valuation, independent evaluation of things like that you need to be attentive to before you issue receipts. And then the rules around the keeping of receipts that are pretty straightforward, but it's really the issuing of receipts that needs extra care. Corporate status is another theme to keep in mind. One of the things that charities and nonprofits have to recognize is that they're subject to two fundamental streams of law. One is on the corporate side, the Societies Act or the Canada Not-for-Profit Corporations Act, or maybe the cooperative legislation under which they're incorporated. That stuff is really important, and it's different depending on the act that you are created under. And then there's the the charity side of the equation, or if you're a nonprofit, excuse me, the less complicated, less onerous nonprofit rules under the Income Tax Act. So I like to just, in a basic, simplistic division of things, Income Tax Act versus corporate governance legislation, and keeping those two things up to date and in good standing is really important. And I've noticed over the years quite often the corporate stuff falls down quite often. Folks will be, for example, incorporated under the Nova Scotia Societies Act. They'll do their basic annual returns to the Joint Stocks Registry, but they'll do things like not submit updated bylaws. And things like that become challenging for them if they're operating under bylaws that aren't official. If a problem arises and there's a question of procedural propriety, you need to make sure your bylaws are current. And to do that, they need to be registered with joint stocks. The same applies with federal incorporation if it's the Canada Not-for-Profit Corporations Act. But those two acts are quite different. So if you are perhaps involved with two charities or two nonprofits, as many are, you need to remember, okay, what is my corporate law? What applies to me? How am I incorporated? How's the organization incorporated? And that's a pretty important piece of the puzzle. And sorting that out helps you determine what rules apply because they are quite dramatically different. If you compare, for example, the Canada Not-for-Profit Corporations Act to the Societies Act, one is more than 10 times the volume of the other. The Nova Scotia Act is a very dated, minimalist, and largely inadequate piece of legislation. And the federal one is a perhaps over the top in the opposite direction. So just recognizing that there are two different sets of corporate law just from that perspective. There could also be co-op if that's the structure you've adopted. Or maybe it's an organization incorporated in another province doing business here. So sort that out and be on top of it and get help with that stuff where you need it, because that's an area where you can get into trouble. The good news on the corporate side of the equation is that there's rarely much in the way of recourse. The regulators aren't in the business of slapping hands or getting people into trouble or issuing fines. They just want to make sure you comply with the rules and do the basics to stay in good standing with them. But it is an area where folks do go offside. Causing environmental damage. That's a big issue. It's not something that every organization's in a position to do, and hopefully none ever do, but it is an area where there is potential for significant consequences, fines and penalties and so on for environmental harm. So if your nonprofit or charity is doing something that could lead to some kind of spill or other harm to a local ecosystem, make sure that you're applying real care around that and give that special attention, because you really don't want to be, first of all, it's got the potential for a fine or some kind of penal recourse from the state, but also the public relations disaster that would flow from something going badly wrong on the environmental side really justifies paying extra attention to it and viewing that as a priority on the risk spectrum. So moving along, the second category of the five categories of risk is governance risks. These are pretty self-evident things. We've probably all seen them in different ways and been involved in various ways as directors and volunteers and so on. But unskilled board of directors is an issue. You don't all need to be professors of governance to be directors, but you need to have to do a basic understanding of the work of the organization and apply your best judgment. So poor decision making, poor governance flow from an unskilled board of directors. Inattentive board of directors, a very common theme. I have lost count long ago of the board challenges that I've encountered where some directors don't even follow or participate or engage properly. And those are the sorts of things that can be really poor governance. So weak leadership, poor results, having a board that's not engaged. If you're not willing to be engaged and attend every meeting, barring illness and other serious obstacles, then don't participate as a director, because somebody else will step in and apply the attention and effort needed to do it well. You may be the most skilled director in the world, but if you don't attend, you're not adding any value. So don't participate. Conflict of interest is another governance risk. Um, the conflict of interest is a largely misunderstood concept or conflated concept. Basically, it's any circumstance where a director puts his or her personal interests ahead of those of the organization and benefits, profits from that engagement. So that's what you want to avoid, conflicts of interest where people are on a board to effectively seize opportunities for their own personal benefit. So don't ever allow that to happen. If you see it happening around your board table, stop it. Um, it's pretty easy to remedy. You call it out. The person in the conflict doesn't engage in decision making, and you carry on. So it's poor governance. It creates internal strife, and it's pretty damaging to the reputation of the organization too, to have conflicts of interest that involve directors effectively taking opportunity for their own private profit. So do not allow that to happen in your organization. Next slide, some more governance risks failure to comply with bylaws. That's a very practical thing that many organizations run into trouble with. What do their bylaws say? I've again lost count of the number of engagements I've had with charities where I've asked for a copy of their bylaws and they really struggle to produce them. Well, those should be at every director's fingertips. There should be a binder of materials that includes the incorporation documents and the bylaws, and those should be updated. It can be really bad governance to not be complying with your bylaws. It opens you up to challenges from your members, but it just generally leads to the potential for sort of chaotic governance. So always remembering on the governance side of the equation that the members and the directors are sort of the heart of that relationship that's spelled out in the bylaws. So who are your members? Knowing who your members are is critical. And then who have they elected to be the directors? And that basic relationship is at the heart of the bylaw language and the provisions built in there. And most bylaws are pretty standard and consistent, but there are some variations. So knowing what your bylaws say is really important. And it's also good to recognize that you may have bylaws created in 1977 that haven't been updated, and the world has changed a great deal. So just part of good governance and therefore of good risk management is keeping bylaws current and revisiting them. And I generally encourage every 3 or 4 years for boards to look at their bylaws and see are they working? Because there are a lot of variations that you can adopt in your bylaws to improve your governance, to really customize how things work. But at the heart of it is this question of who are your members and who are your directors. And you can have a pretty pared back basic set of bylaws. That's just fine. But know what they are. And if they're not working for you, look to see what revisions you can make. And there's some good resources out there. If you're federally incorporated, there's a magnificent tool called the Bylaw Builder tool that walks you through model bylaws and gives you choices on all of the decision points. And you can, in about half an hour, produce a really good, robust set of bylaws without a single dollar spent on legal fees. And it's a really great service. Unfortunately, the Nova Scotia Act doesn't have that capacity, but you can customize your Nova Scotia bylaws if you like. And there's quite a bit of elbow room because the Act is so Spartan. There aren't a lot of constraints in the Act as to what you put in your bylaws. So you have quite a bit of discretion there. So bylaws very important. Director-member relations, touched on that. Poor board staff relations. That's often where friction arises. And when there is litigation over an employment dispute, that's often the result of a poor relations between board and staff. It leads to a lot of difficulty. So these are themes on the governance side that you can always improve. And there's no sort of single fix for anything. How do you get a good relationship between staff and board? In my mind, there's a very constructive tension that can arise when a board and a staff team are really working well, where they bring out the best in each other. And it's not just the board being a rubber stamp for the chief staff person. It's a challenging and encouraging and in a really positive way, bringing out the best of the whole team. and it's a bit of an art. There's not a single blueprint for this, but that's sort of the goal. Whenever I'm volunteering on a board or brought in to speak to boards, I always look for that. Is this a board that's really working to bring the best out of their staff, and is the staff rising to the occasion and tapping into the wisdom of the board? And that's a really neat dynamic when you see it going really well. So sort of strive for that sort of creative, constructive tension if you're able. The next one is operational risk. So this is number three of the five categories of risk. I hope there's not too much droning on, but we'll just look at some of these things quickly, and they're pretty self-evident. Unsafe premises, for those of you with facilities, you're all very attentive to, making sure you do your snow plowing and shoveling and salting of steps in the wintertime and making sure the place is safe. You don't want somebody falling and getting hurt or any physical harm of that nature. Um, it also includes things like mismanagement of assets. Are things uh, being mismanaged? Is our capital assets being wasted? Is there inadequate care being provided to the assets of the organization? Those are important pieces of operational risk management. Poor recruitment and training practices, those are things to avoid if you're able. You can end up with lawsuits around injuries and damaged reputation from poor recruitment and training of staff and volunteers as well. Next one. A similar theme here, inadequate supervision of staff or volunteers, inadequate record keeping, another operational risk. On the financial side, that's an area where many organizations struggle to get the bookkeeping and accounting skills they need to keep proper books. It's a complicated thing if you have a nonprofit or charity with a significant staff team and a lot going on. The record keeping process is it's a lot of work, and you need the skilled people to do that, and often that's a real strain point from an operational perspective. Do you have the finance department that you need in order to do the HR function properly, for example? Because a lot of risk can occur there if that's not done well. So keep in mind the importance of that. And if you're many organizations struggle with core funding for those services, and there's no sort of magic formula to secure that funding, but many funders recognize the critical nature of that finance function and will provide resources to help you with it. Failure to fulfill contractual obligations and other operational risks can lead to lawsuits and damaged reputation. A bunch of costs can arise. So I see this quite often with organizations that have funding agreements for very specific pursuits, maybe a government funding agreement. And then very often the work gets done, but there's a fall down when it comes to the reporting of it. So recognize when you enter into a funding arrangement with a provincial body, for example, they'll have very specific funding, reporting requirements tied to the funding. And that's where the relationship often falls down. So I've seen many charities and nonprofits that have gotten into the unfortunate position of having a big backlog of reporting that leads to cuts in ongoing funding. So pay extra attention to that. Effectively read your funding agreement carefully, because they'll be often quite long and complicated things. The key parts are, what are those reporting obligations? And often if you don't do those relatively manageable basic reporting things as part of the relationship, you'll lose funding, or you'll have funding held back and you won't be renewed, that kind of thing. So contractual obligations and the reporting component of contractual obligations require extra care, I find, in the charity and nonprofit world. Financial risks sort of related a little bit to what we just spoke of. Inaccurate or insufficient financial information is an issue. And here's a theme that some of you may have encountered, and I'll share it as a growing theme across the country. And it is the challenges around audits. For those of you who have crossed the thresholds of requiring audits or even review engagements, in some cases, there seems to be a shortage of accountants willing to do the audit work for the sector. So if you have a young person in your world who's considering a finance career, I strongly recommend they pursue the skills of an auditor because there's a huge demand. My goodness, the number of times I've heard lately of charities not getting their audited statements on time because of the press on the auditor. It's just, I've lost track of it. So interesting challenge. How do we get financial information that's accurate and timely to enable boards to make good decisions? So there's the internal bookkeeping and tracking of things so that the board can be updated. Management knows how you're standing, what your cash flow is. That's really important stuff. But then there's that external review where it's getting worse, and just the challenges of finding an auditor who will be punctual, who's able to be punctual, is a big one. So really important piece on the financial information side of things internally, getting the skills to stay on top of your organization's circumstances. Challenging, very, very challenging, increasingly so. Inadequate cash flows or reserves. My goodness, that may be the one universal that runs through almost all charities and nonprofits is the constant challenge to find the resources needed to do the good works. So if you're struggling with that, you're not alone. It's a pretty standard thing. How successful you are is really a measure of the entire team's efforts. What kind of funding have you secured, and how consistent and reliable is it, and how vulnerable are you to loss of any of that? So limited income sources, obviously a vulnerability as well, a potential risk. The converse, of course, if you have multiple funding sources, that's the opportunity side of the risk equation. A little bit more in inadequate financial controls. That's where an auditor can be very helpful. A good audit will point out weaknesses and areas you can improve, but you can get the help you need from others as well. Generally, accountants are well trained in this, and I always defer to the wisdom and training of accountants on these matters and encourage all charities to have a rapport with an accountant to help them identify areas of improvement because these are constant improvement areas. There are charities that have been in successful operation for decades that are always making improvement on the financial control side of the equation. So don't feel bad if your practices aren't the greatest. Try to make them better. Investment policies and practices for those of you with the luxury of assets to invest. This is an area of importance for foundations. I don't know if anyone here today is from a foundation with an endowment. How do you manage that investment is a big part of the work you do. In fact, foundations focus largely on that side of life, managing their assets to generate income, to make grants, or to do other good charitable works. That's the foundation world. Very interesting space. The final bullet here, just the risk, the opportunities around insurance coverage. Uh, do you have enough or do you have too much? And it's tough to get that balance right. It is possible to have too much insurance. Do you really need all the coverage you have? Is the coverage you have appropriate for your work, or is it based on what you were doing 10 years ago when the world has changed? So basic advice I give on insurance, I'll give it now and won't need to mention it again, I don't think, is strike up a good rapport with an independent broker whose work can include advice on what makes the best sense in your circumstance, and avoid over-insuring and avoid being in a circumstance where a loss would be catastrophic to you. So it's a fine balance. There's no absolute right or wrong, but be an informed, be a somewhat skeptical consumer of insurance, and try to be as informed as you can on options. External risks, is a little bit similar to some that we've looked at, but a little bit of new stuff here too. Loss of key funding source. That's a big one. A lot of charities are struggling with that all the time. We're going through now a federal government process of some contraction from some areas of grant making. Some of you will know this firsthand, where some are going to lose significant federal funding. Some already have. Same as applied basically in my Rita, the Nova Scotia scene is every time there's a change of government, there's a whole new series of priorities, and there's a real scramble for those nonprofit and charitable organizations dependent upon provincial funding. So those are big risks. Some foundations, to give you some examples from that space, grantors, foundations that make significant grants to charities will often have fixed terms in effect. They'll say, okay, here is a 2-year grant or here's a 5-year grant. And that's that. At the end of that significant grant, there's not a renewal. So that can be a big challenge. What do you do at the end of 5 years? So just as an example in that space that I'll share because it's a fabulous story, I've been working with the Olneweg Indigenous Communities Foundation on a partnership with MasterCard Foundation to do grant making in the Indigenous communities of the Atlantic on an array of fronts, really around education, employment, and entrepreneurship for young people. And they did an initial 5-year grant, and then they said, well, we're going to give you another 5-year grant. So a 10-year commitment, which is almost unheard of in the foundation world. But it's an example of how foundations do recognize that 1-year funding or 6-month funding or 2-year funding just is really a band-aid on a problem as opposed to allowing systemic progress and improvement. So are there funders out there who will be with you for the long haul? Well, there may be, and I wish you all luck in finding them. Enlightened funders will do that, and to the extent their resources will permit it. It's a nice place to get if you're lucky. Um, Changing government priorities, we touched on that, but it's pretty self-evident. Governments change, so do their community development priorities and so on. You can expect challenges around change of government and reduced income, investment income. That's a tough one to predict. I've been notoriously bad at predicting where the markets will go, and it's been a good thing I've not been on that side of the equation advising. I would have say take it out of the stock market years ago, and wouldn't have been good news for those who follow that guidance. But there we are. How do you invest well to generate income from your endowment if you're lucky enough to have one? Fortunately, most foundations seem to have known what they're doing, and the resources under management by Canada's foundations has grown very steadily, and they're in a pretty robust shape generally to continue their good grant making work. Some more external risks, changing demand for services. It's pretty self-evident. Competition, maybe somebody new comes to town that does what you're doing better, and you're in a position where you need to change what you do to keep up with the changes in the community. Loss of donor confidence can be an issue. Again, a reputational thing. If things go badly, that can have a direct impact on your donations. I don't know how many of you are charities and how many of you have connected with Canada Helps, but that's a wonderful resource in the charitable world for sort of tracking your donations and plugging into the intelligence around donor trends. So if you want to do some homework on the individual donation patterns of Canadians, it's a great resource. And these are folks you can reach out to and get guidance from directly. So not only are they a conduit in the positive sense to get dollars to local charities, they are themselves a charity, and their purpose is to make other charities more efficient. And they do that through their online system of giving and receipting. But also they gather a ton of intelligence. And I just like to share the idea of reaching out to them for intelligence in your space. And you can get a sense of what's happening in Nova Scotia more locally than that, and also sort of divide things by sector to see what's happening across the board. They have wonderful data just because of what they do. They receive and issue receipts to millions of donors, and then they flow those dollars to the named charities in those transactions. So Canada Helps, a beautiful, wonderful asset for tracking data, and sort of the loss of donor confidence made me think of just sharing with you, if you haven't yet connected with them, the value of that for charities. Slide 16, some basic risk management strategies. So we've looked at subdividing risk out into 5 categories. Maybe that's too many. You could maybe reduce that to 3 or 4. But that exercise was basically, okay, let's look at all of the things out there that we could we could put under the heading of risk, recognizing the opportunity side of the formula. And then what do you do with risk? How do you deal with it? There's no magic formula, no secret that you need a handshake to get access to. Uh, Three basic things. You can avoid the risk, stop doing the thing that might create the problem. Uh, Conversely, that's not do what might be an opportunity. You can transfer it. You can use insurance or outsourcing to transfer the potential negative consequences of an activity to a third party. That's what insurance is. Or you can accept and manage the risk and do your best with it and hopefully just take advantage of the positive side as opposed to the negative. So you can do these can be done in conjunction with number two. Take prudent practical steps to reduce the risk, training, supervision, physical alterations, those kinds of things, depending on what you've identified the issue to be. So three things is pretty simple, really. At the end of the day, very intuitive. I'm sure if you'd spent 10 minutes pondering it, you would have all come up independently with these three things you can do to manage risk. The next slide speak of creating a risk management plan. And basically the suggestion here is that that plan have five elements. So establish a risk policy as a starting point, identify risks, assess the risks, so break them out and then break them down, and then evaluate the actions to take on the risk. So do you not do the thing? Do you outsource it? Or do you manage it? And what management steps do you then implement to accomplish that one? And then you monitor. You monitor periodically to see if you're doing well, if things could be done differently, if you, and glean whatever lessons you can from the effort under the plan. So here are the five elements. If you like, we can get right into those. So a risk policy, what is that? And there are examples online you can pull down as a bit of a guide and convert it to a template, but a document that describes your approach to risk. Lots of different forms. Some possible subject matters, a purpose statement. What is this document? Well, it's here to help the board, the staff, the volunteers, the members navigate in the space that it's occupying. Uh, Key principles can be stated, identify the responsibility of the board and staff and volunteer commitment and so on. Commitments to diligence and to attention and to assessment and evaluation and ultimately to improvement. Because these are sort of continuous improvement themes, each one of them. You learn lessons as you move along and you try to get better at it on a regular basis. So you learn your lessons and carry on, hopefully in a better position. So risk policy, subject matter, if you're looking at sort of subcategories within that document, specify the board role, identify the responsibilities of staff and break those out. You can identify, okay, here's what the executive director is to do, here's what the finance people do, here's, put names in effect to tasks and responsibilities. Be clear on communication. There's always a big theme in good organizational success is good communication. Description of a risk management process. How are risks identified? How are they brought to the attention of others in the organization? How are they dealt with? What goes to the executive director? What goes to the board? Those kinds of matters you can try to document in the policy so that you have a place to turn as a roadmap. Regular risk review and refinement should be part of. We've spoken of that again. The learning of lessons. And here, there's a sample that's in this material. I hope it's still current. I didn't check to see if it's still live, but there are others out there as well. This was one again from the UK's guidance of a good policy, and I looked at it when I crafted these slides, and I thought, yeah, this is a great example that could be modified for just about any organization in Nova Scotia because it's not in the Welsh language. Number two is identifying risks. Board staff, volunteers should collaborate to examine all aspects of the organization's operations. And when new things come along, that they should be identified from and scrutinized from a risk perspective. And again, back to the five categories of legal, governance, operational, financial, and external. Break things down and take that same sort of methodical approach to it. It seems to help simplify and make more manageable to break things down that way. And then assessment. So you've identified a risk. What do you do? Well, you turn your attention to it with two basic things in mind. What's the impact and likelihood? And that then helps you determine how urgently or not a particular risk or opportunity should be pursued. So this is pretty basic little formula that you can apply to any circumstance. You can vary this obviously, but it illustrates, I think, reasonably well the basic task. Is this something inconsequential and significant that really doesn't matter what happens? Or is this an extreme thing that if it happens or if you miss the opportunity, it will have dire consequences for the organization? So I don't think I need to say much about this other than impact and likelihood would be an intuitive way to tackle any new thing that comes to the door. Is it something that's of moderate importance or impact? And if it's moderate and probable as an occurrence, well, geez, this better come to the executive director before lunch so that she can start turning her mind to the best approach to it and make it part of the team deliberations. Evaluate actions to be taken. So again, pretty self-evident concepts here. It's back to those three basic choices. Do you avoid it altogether? So if it's something you're doing, do you stop doing that? Or do you not pursue something because of the risk analysis you've just done? Do you transfer it? Is this something you want to talk to your insurer about? Or is there perhaps someone else who can do that, who's better at it, and you can collaborate on it? And that transfer piece isn't just insurance. It is, are there sibling organizations in your world uh, with whom you should have engagement around opportunities and risks, and perhaps one of you takes it on and shares the proceeds, or uh, there is capacity to transfer in that way of outsourcing that isn't just contracting someone to do it, but passing an opportunity off to another sibling organization, perhaps, and then collaborating, cooperating in that way. Or finally, in most cases, it's accept and manage. This is in your wheelhouse. It's something kind of unavoidable. You're going to need to deal with it. It's part of the new reality, the changing circumstances in your community. Let's accept it and figure out the best way through. So then you're into how best to do that, and that's the process we've already touched on. And then the monitoring exercise, which is part of all that you do as managers of organizations, as leaders of organizations, um, always be scanning the horizon. Watch for new risks. Is something new being undertaken by the organization that involves a new dynamic? If so, is there something inherently problematic, or is there something that's a wonderful opportunity that could be expanded and replicated? Or does it lead to, oh, well, look, this has taken us to a new funding source. Let's give this the attention it deserves because we've just tumbled across a new foundation interested in this very thing that we're doing. So that's all part of again, the positive side of risk management. Pay attention to changing circumstances related to your activities. Many organizations are really dynamic, and I can think of many that I've helped over the years where it's actually tough for managers to keep on top of it. You've got such an active staff team and volunteer team doing great works that keeping on top of it and having the luxury then to analyze it along these lines might not always happen because you're a few weeks or months behind what's actually happening on the ground. So it's sort of incumbent upon the more senior members of the team to bring this to the equation and to make sure that it's sort of thought through carefully. Often the planning phase of new activities, it's a really critical time to apply these principles and approaches, but often things are already underway before you have the luxury of turning your mind to it. So try to keep up, I guess, is the bit of a challenge for the more senior members of a vibrant team. Evaluate performance for lessons. What did you do well? What did you do poorly? What opportunity might you have missed? can you recapture that opportunity, or is it gone now and you should just move on? Um, Look outside for best practices. Who's doing something really well? One of the things that this session and others like it are proof of is, or evidence of, is the collaborative nature of the sector, the cooperative DNA that is part of the nonprofit and charitable world, where the sharing is extraordinary. So someone will learn a lesson one place and share it with colleagues and lift, the rising tide theory really does work in this sector. I see it all the time. So look outside for best practices. Are there lessons to be gleaned? Are there lessons for you to share? And how do you do that? And organizations like this are exactly the place to do that. And seek advice. And sometimes that advice is from a sibling volunteer, director, or staff person at another organization. And again, the sharing of experiences I find is really encouraging, and it is part of being in this sector is the willingness to do just that, to make everybody more successful. Encourage ongoing learning, things like this, doing deeper dives. If one of you comes up with a fabulous policy statement on risk for your organization, share it with the others and see if that helps them along the same path. That encouraging ongoing learning can take many forms. There isn't a single place to go to master all of this stuff. It's a matter of experience and gleaning what you can from different circumstances and then applying it. And the final point on this slide is re-examine your insurance needs annually. That's very practical advice. Very often the insurance analysis is the bill comes in and you pay it and that's it. But there should be more to it. And if you have a relationship with a broker, they're often very helpful in terms of learning about what you're paying for. What is it? What are you getting for the premiums that you pay? Because often they're very significant line items on a modest organization's financial statements. So be attentive to that and seek advice. And what can you do differently that might reduce that coverage? Are you overinsured? Are there other approaches to risk that might be more cost effective? And good brokers will be frank with you and give you good advice and say, hey, you'd probably be better off with this option over that one, and it might be good for your bottom line. So we're just approaching 8, and we're approaching the end of this slide. So Heather, what would you like me to do? Did you want to stick with the pause idea, or would you like to finish the slides and then come back in a few minutes for Q&A?
Uh, that's entirely up to you. If you don't need a break, maybe we could finish the slides and then come back and
Just a
have a
couple more
question
minutes.
period. Yeah,
Okay, that's
it's up
great.
to
Let's do
you.
it that way.
Okay.
Makes good sense. So the insurance one, I think I've said enough about. Uh, there may be folks on the call who know a lot about insurance and realize you can't really do much in a couple of minutes on it. But this slide just identifies the general types of insurance, directors and officers liability insurance. In Nova Scotia's, it's complicated by the Volunteer Protection Act. And that's another topic for another conversation. But the idea of D&O coverage, if your directors are volunteer, it's kind of a waste of money. Some may feel pressured into it. Some may get talked into it by those arguing that the act is an adequate protection. But the Nova Scotia Volunteer Protection Act is a pretty neat one. Basically, it says that unless a director or other volunteer with a charity or a nonprofit is grossly negligent, they're not going to be personally liable for anything that occurs in the organization. That changes the test from basic negligence to gross negligence. Gross negligence is pretty serious stuff. Like that would be bringing a handgun to a daycare, that kind of stuff. So just be aware of the Volunteer Protection Act gives you good protection. It's designed to help organizations like those that you're part of, and it does it. It does it well. We haven't had a wash of litigation directed toward volunteers and directors of nonprofits and charities, and I think that legislation has helped. Um, Policies differ in the insurance world. Watch out for exclusions like dishonest, fraudulent, or criminal actions, breach of contracts, wrongful dismissal. The devil really is in the details of insurance policies. So again, um, having a broker working with you to offer comparative analysis of coverage because they're not always the same, and those exclusions are the key pieces of that. Be time well spent if your staff trying to be the most efficient consumer of insurance. That's a good way to go. Find a broker who will help you through it if it's not expertise you have yourself. And not many people are sort of experts in insurance. So understand the coverage, weigh the costs, potential benefits, review the insurance needs regularly. I suggest annually, and do not rely on your insurance. Do those other things that manage the risks, and view insurance as a backstop if things go badly wrong. And that's a healthier approach. And I think we're right at the end. Independent advice is a final piece of the puzzle, helping organizations get to good answers. If you have an accounting question, don't just wing it. Speak to an accountant who knows the subject matter. If it's an engineering problem with a physical structure, we'll get an engineer to give you advice. Pretty obvious stuff, but don't hesitate to do that because it does a couple of things. One, most importantly, it helps you avoid the problem by getting fixed or done properly what needs to be done. But it also brings uh, liability protection in the form of a professional opinion or action that helps spread the burden of potential liability. So if you rely upon the advice of your accountant and are wrong, well, there's the potential that the accountant was negligent and his or her insurance will be brought into the equation. So independent advice, most importantly, helps get the right answer, but it has that ancillary benefit of helping spread the burden of a mistake. So there's just some simple examples there, and you can think of a lot of different scenarios too where independent advice could be very helpful. And finally, a summary of the duty of directors might be helpful at this time. So to wrap up point, this is again a theme that could be another conversation on its own. But if you are a director, act honestly in good faith and in the best interests of the organization. Avoid personal interests that conflict with the organization's interests and apply your best judgment to each decision. If you do that as a director, you're managing risk well. You're meeting the standard that's expected of you in law, and you're hopefully going to be contributing to good decisions and good outcomes and seizing the opportunities. So I always like to wrap up on that theme that there's the negative side of this that can really bum folks out. But the positive side is if you do these things well, you're identifying early opportunities and seizing them and running with them, learning lessons from them, and running even further and faster. So view it from a positive perspective, and it's not quite as exhausting. I think that's the end of the slides.